Being charitable and giving is a wonderful calling. We want to be able to maximize our gifts both to the charity and to our family legacy, what it is that we're leaving on for our children, because a legacy, in our opinion, is far more than just money. Today on Consider This program, we're going to talk about how your giving journey should be. If you're compelled to be what we call a better giver, if you're compelled to give to charities and to churches and to your community, we want you to get the biggest bang for your buck from tax efficiency. We want your charities to get the most impact they can. And we're going to talk about the best time to make those gifts on Consider This program today. Well, good morning and welcome to Consider This program. I am your host, Joe Clark.
And I'm Adam Harter.
Happy to have you along, Adam. Adam is one of my partners. He's the Chief Investment Officer at the Financial Enhancement Group. As of the time of this recording, we take care of a little more than $680 million, and as the managing partner and him being the chief investment officer, I guess it kind of falls on our shoulders more than it probably does anybody else. But collectively, our team of 38 is able to get a lot of things done. We use this show every week. If you're on WIBC listening, you don't get to hear one of the segments of the show, so I would always encourage you to go to our podcast. Consider This program anywhere you listen to podcasts, and you can get the segment that you missed. But we're going to give you three things today that are talking about breaking the rules of retirement. And it's really not as big as that. It's not breaking the rules. It's just thinking about it in a new way, a new fashion, if you will. Adam and I both greatly believe in legacy planning, and that's passing on more than just money. And for both of us, and for many of the families that we serve, there's a little over 1,085 of them right now across the country. For most of them, what we deal with is charitable giving. And a lot of times that charity tends to come when people are gone, how they leave money behind. Adam and I are going to try to give you some things today to think about in your entire journey, not just when you're gone, but things you might want to consider about why you're here as well. So Adam, I'll let you take it away.
Yeah, Joe, I couldn't agree anymore. That's charitable giving's a big part, and far too often I think it's just human nature that we develop this mindset that we accumulate assets, and a portion of that's going to go to charity, and so we use them while we're alive and give the remainder to charity. But we find you can go so much farther, not just monetarily, but you can go so much farther by giving during life, and that's a strong point of ours when we're meeting with people and discussing legacy planning.
So you really have a few different scenarios, right? You've got people who have kids who are giving. You have people who have no kids who are giving, right? And you have people who have many beneficiaries that are out there that they want to give to, and really pass that legacy on. So let's pretend Barb and I are 54. I'll be 55 here on Christmas Eve coming up, but we're 54 years old. We go to it. We give to our church. We've got some definite things that we want to leave behind as a legacy, when we're both gone for the community and for other charities that we take care of. What should I really be thinking about today, almost 55 years old?
Well, at 55, you may be thinking, just like I said, you may be, if you're charitably inclined, given a portion of your income now, is would be my best guess, knowing you. But you may want to be considering giving out of assets as well, in the here and now. And I'll tell you why. That gift can go so much further during life than it can during death, both in money and in terms of satisfaction seeing that gift be put to use. In fact, one of the strategies results in what I call a triple bagger, given it today.
Adam's a sports nut, so that's not surprising.
Well, it's just a way that I can understand it in simple terms. So here, when we're talking often in investment planning, I've got to come up with ways to remember it.
Right.
An investment playbook, I've got that, but planning, I've got to have ways to remember. And a triple bagger, giving today can result in a threefold tax benefit to the giver. Not only can you get a benefit from a tax deduction, writing it straight off of your income return today, you may be able to also avoid some capital gains tax. And number three, also estate tax. All depends on your situation, but that may possibly be something you could consider even at 55.
It is one of those things, and you've got to look at understanding while I'm alive, I'm paying taxes on my 1040. When I'm dead, I'm filing one file, somebody's filing it for me, one final tax return that's called a 706. That's your estate tax return. People forget in that year of death, you still file the 1040 right along with it. And so what Adam's talking about when he says an asset, let's just use Apple stock. Adam and I we don't claim to try to hit home runs. We try to get on base and score runs in our investment policy. But we were fortunate enough to buy that little fruit company that Forrest Gump talked about, Apple, back in 2006. And all you have to do is look. We've had huge amounts of appreciation, and inside of that. And so here I am at 55 years old. And if I told you, Adam, and you were in planning mode, that and we're long Apple, we have to say that for the radio. That means we own it, a lot of it. So we take, and I tell you that I want to make a $10,000 gift to my charity, to my church. What would you tell me to do?
Well, that's an absolute no-brainer. If you gift that Apple stock to the charity rather than giving them $10,000 in cash.
Okay, so let's pause. Let's pause there because I had somebody argue with me on this the other day that is in the tax world. And they said, if you don't itemize, it doesn't make any difference. And one of the things that Adam and I will try to convince you to understand and consider is your financial journey is a mixture of multiple things. And to ignore taxes today and tomorrow is a huge, huge mistake. So, Adam, why were they wrong?
Oh, well, number one, we live in a world where we don't ultimately know what's going to happen, tax code. So, number one, even if you don't itemize and you take a standard deduction, in that scenario, when you give your Apple stock to the charity, you can still benefit by stepping up your basis and not being exposed to too much capital gains tax. And as we found out, you don't know, there could be a point in time when all of a sudden we're taxed on those unrealized gains. So it's not as simple as even saying you're going to pass that along to your kids who will not pay tax on it. It isn't that simple.
So it's true, you don't get a deduction if you take the standard deduction. You don't get that. But when Adam talks about stepping up your own basis, typically people talk about step up a basis at death, that your family, under the current tax code, if you passed away, the assets would get a step up in basis, meaning that the tax ramifications for most assets would be gone. That's not true of IRAs and 401ks and tax deferred assets. But in this case, we like Apple. We've already fessed up to Apple. So I want to make a gift to my church of $10,000. I transfer $10,000 of stock directly to the church. I didn't sell it. We sell it in the church's account. Church pays no capital gains. And you say, well, I don't want to get rid of my Apple. I like my Apple, right? So I actually give Financial Enhancement Group into my account the $10,000 in cash that I would have normally given to the church. And Adam turns around and buys more Apple. So all we did was step up our basis internally, right? So one of the challenges that you have to understand, if you're investing wisely, that means that things will change. We rarely buy an entire position at one time of something that we're going to buy, and we rarely sell it all at one time. It's usually move in and out. And we've bought Apple at least 5 times and sold it, obviously, since 2006. Not all of it, but when it goes above 5%, rules are rules. We believe in diversification, and we sell it and trim. And when the stock fell down in value, we bought more back. Right, so it's you want to be prepared for that financial journey. Adam, in the few minutes that are remaining, what other big thing would you tell me to do if I was 75 years old and I've got an IRA and I've got and I'm taking the standard deduction?
In your charitably inclined, then you have the ultimate no-brainer. Maybe as much of a no-brainer as there is in a financial world, where there's so many things we do. There are 2 sides. There's only one side on this one, and I think we both agree on that. And that is to take advantage of your QCD, your qualified charitable donation. So where you can give the money to your church or charity out of your retirement account rather than giving cash.
So you don't get a deduction. You have to be over 70 and a half. It has to come from an IRA other than 2021. There's a loophole there where you can actually pull it out of a 401k and be over 59 and a half. But that's going to go away December 31st of this year. So focus on if you're over 70 and a half. So people my age that have parents, right, that are 75 years old or 80 years old, I think mom's 78 now, If she was going to make a gift to her church, it's likely at the income range that she had, she's taken the standard deduction. Right now, I happen to know she is, but it's likely. You don't have to see your parents' tax returns to know this, by the way. But if they have an IRA and they've got money in an investment account separate from the IRA, the money that you want to inherit is the money that's in the separate account, not the IRA, right? So counsel them, teach them to use what's called a qualified charitable distribution. Money goes directly to the charity. They don't get a tax deduction. It satisfies or can satisfy the required minimum distribution. And they don't have to pay taxes on that income, which could help in all sorts of ways. With Medicare Part B, it could reduce the taxation on their Social Security, right? And it just sets you up for that. And I will give you in the last one of the big mistakes that I see people make, because we do live in a world where Adam and I see $1 million 401ks and IRAs on a regular basis. And then I sit down and I look at the trust. We do believe legacy planning is important. And inside of the trust, people have made charitable bequests to their churches, to their universities, to community foundations. And giving charitably is a beautiful, beautiful thing, ladies and gentlemen. I'm all supportive of that. But let's give the best asset. Let's use our talents just like we would when we were alive. And it's much better for you to give that tax-deferred asset, the IRA, the 401k, directly to the charity upon your death. Again, the charity doesn't have to pay any estate taxes. You pull it out of your estate from that standpoint. The second thing that you're able to do then is to give more of the money that's already been taxed, hopefully with a step-up in basis, to your kids. So we've got to think about what we're doing today, tomorrow, and into the future with our charitable gifts. Go to yourlifeafterwork.com. Get signed up for a Next Steps meeting. We look forward to sharing some gifting strategies with you.